Welcome back to Accounting Matters, the podcast that unpacks today's most important financial reporting topics. I'm Nicole Harger, a Senior Managing Director here at Embark. And as always, I'm joined by my co-host, Adam Olsen, Embark's Head of Firm Quality.
How's it going?
Good.
Good to see you.
Good to see you. We're back.
Yeah. Let's dive in. What are we talking about today?
Yeah. So today we're diving into a topic that's both nuanced and increasingly relevant: accounting for collaboration arrangements. So these types of partnerships have become a staple in industries like life sciences and technology, and really with good reason. They let companies pool expertise and share risk and accelerate innovation, but the accounting is far from straightforward.
Yeah, no, you're absolutely right. And I think we're seeing more of these come into play, like you said, specific industries that deal with it, whether they're, have arrangements for IP licensing or kind of joint development of products or services, arrangement with milestone payments, and just, people really kind of looking to share a lot of commercialization efforts, especially in kind of hyper growth industries.
Yep.
There's a good chance that you got to think through the accounting guidance in a couple areas. So ASC 808, which kind of governs the collaborative arrangements guidance, but then also ASC 606 can have its head kind of rear here as well. So figuring out how you apply them, how they kind of intersect and kind of relate to each other, I think that's where people tend to struggle the most and where things can get complicated.
Yep. Okay. So today we're going to walk through really what qualifies as a collaborative arrangement under ASC 808. We'll discuss how to assess whether a portion of the arrangement falls under ASC 606, when and how to apply ASC 606 by analogy. We'll talk about some examples from the life sciences and tech sectors. We'll also discuss SEC hot buttons and disclosure expectations, common pitfalls, and then we'll wrap up with a few best practices to help you navigate the accounting and reporting landscape.
Be experts by the end of this, right?
That's the goal, right? Okay, so let's really start with the foundation.
Okay.
What is ASC 808 all about?
Yeah, so like I mentioned, ASC 808 provides the guidance that really kind of governs collaborative arrangements. So, right, these are contracts where the parties are active participants and share both in the risks and the rewards of whatever venture they're kind of focused on, right? What it's not is really a complete accounting model. So unlike ASC 606, which we're all familiar with and very robust and has all the steps lined out and things like that, ASC 808 is pretty bare bones, I would say. So it really gives you kind of the definition of, from the master glossary of what these terms mean, and really kind of just outline some of the disclosure requirements if you do have some of these arrangements. But it doesn't really go into specific criteria or guidance or whatever to explain how you should either measure or recognize kind of these arrangements. So whether the income or the cost, et cetera.
Yeah, that's a key distinction. So unlike 606, which gives you the full roadmap of revenue recognition, like you talked about, ASC 808 really points you to other GAAP when it comes to accounting for the arrangement itself.
Yeah, exactly. So the first thing you really kind of have to ask yourselves when you have a potential arrangement that you're trying to evaluate whether or not it falls under that 808 guidance is like, do you truly have parties that are collaborating? So this typically means that both parties are contributing their own resources. They're both involved in kind of making key decisions. And again, they're both like bearing kind of the risks and the rewards of that activity.
So it's not just a vendor agreement or a customer transaction. It's more of really a joint effort with shared upside and downside. And then once you determine that ASC 808 applies, really the next big question is, how do you deal with portions of the arrangement that might actually fall under other GAAP, like ASC 606?
Yeah, and that's where things can get a bit nuanced, right? If there's a distinct good or service being transferred to a customer as part of that collaboration, and that good or service meets the criteria under ASC 606, then you're going to apply ASC 606 to that unit of account. So unit of accounts are really important here. And then again, for that unit of account, that also includes the recognition, measurement, presentation, and disclosure guidance. But if part of the arrangement doesn't involve a customer, for example, you've got internal cost sharing or just a lot of like R&D type activities. So if you're kind of an early stage company still in the R&D phase between collaborators, then you're likely going to have that piece that just kind of sits under ASC 808.
So you could really end up with a single collaborative arrangement that's partially in scope of 606 and then partially not.
Exactly. And I think that's, that happens pretty frequently where we see kind of the guidance needs to be split out. So again, that unit of account really becomes critical. And it's, again, like that's a big distinction that you have to focus on in ASC 606. And it's going to apply equally here in ASC 808. It really helps drive whether or not you need to think about kind of bifurcating the guidance for those different units of account.
Yeah, and that makes sense. So let's talk about the types of activities that you might see in these arrangements. We're really not just talking about IP development. Collaborative arrangements can cover a wide range of joint operating activities.
Yeah, definitely. So think joint development of a drug candidate. You could think about co-marketing, a software platform or a SaaS platform. In the kind of the film industry, you've got people that are often involved in producing movies, so co-production of movies. And then even in like the healthcare industry, right? Like sometimes there's different collaborative arrangements for just how you operate a hospital or hospital system. So one party might handle the R&D while another might be responsible for more of the commercialization once you get to that phase. Or they might have shared responsibilities that are, across all kind of aspects of the arrangement. So across the board, I think it really kind of depends on the circumstances and just really kind of what both collaborators are kind of looking to do and achieve.
Yeah, so that really ties into the concept of active participation, which really is crucial to ASC 808. Can you walk through what that looks like?
Yeah, so obviously active participation is kind of one of the criterias for being within the scope. So active participation means that both parties are doing more than just kind of putting cash, right? They're not just investing the cash resources, they're engaged, right? They're making those decisions that are important from like the day-to-day activities. They might be sitting on certain steering committees and helping kind of direct the project itself, holding on to legal rights to the intellectual property that's kind of being co-created. And then on the flip side, if only a party's role is to just provide that financial backing, like if you're just giving cash or other resources to help fund, you're often likely not an active participant. And in that case, the arrangement's not going to fall under the guidance in 808.
Okay, so you really need to look at the nature of the involvement, but at the same time, it's not just about activity, it's also about exposure to risk and reward,
Sure.
Right?
Yeah, exactly. So a key piece of qualifying as a collaborative arrangement is that the parties share in those, like I said, we've said this a couple of times, the risks and rewards that are tied to the commercial success of whatever that joint activity is. And this includes things like uncertainty, right? Like in the development process, profit or loss potential, and even just market performance.
And so there can be situations where it may look like a collaborative arrangement on the surface, but the structure of the deal may actually say otherwise.
Yeah, exactly. For instance, if one party is just being paid market rate fees for their services, or if they can walk away, frankly, kind of from the arrangement and recover, most of their investment without any of the risk, then, there's an argument you're not really sharing in the true risks and rewards of that arrangement. Or maybe if all the early profits in an arrangement go to one specific party, or there's a cap on how much someone can either make or lose in a certain case, that may also kind of push you out of meeting the criteria in 808.
So the accounting conclusion is really driven by economics over optics.
Yep.
So you need both active participation and share in risk and reward in order to be in scope of ASC 808.
Yeah. And once that's established, then you start looking at which pieces, again, like coming back to that unit of account, really kind of looking at the arrangement itself and figuring out, are there multiple units of account, and potentially which of those units, if any, might fall directly under ASC 606 or might have to be pointed to other areas of GAAP for figuring out how to account for those. And like I said, it's, these aren't kind of boilerplate arrangements. They're all very unique. They have a lot of different terms and conditions involved in them. So I think this is where a lot of rigor needs to be spent. And just because an arrangement may be described as collaborative in the title of the arrangement or something doesn't necessarily mean it kind of meets all this criteria we've talked about.
Yep. And I think one more thing that's worth flagging, not all collaborative arrangements fall under ASC 808. So If the parties actually form a separate legal entity, like a new joint venture, the accounting may actually fall under equity method guidance, which is ASC 323.
Yeah, I think that's another great point is, the form of the arrangement matters. ASC 808 generally applies when there's no kind of new legal entity that's been created. It's really just kind of that contractual collaboration between the parties. But like you said, once you've kind of jointly created some type of entity and put it in place, then you're kind of venturing into, I think, to other areas of GAAP, which have its own accounting. So just something to bring up. I don't think that'll be kind of the we won't get into that much today, but just wanted to make awareness of that.
Yep. So before diving into the accounting, I think it's important to understand the legal and structure setup. Like we've talked about, is it a true collaboration, or are we really dealing with something more formal like a JV?
Yeah, exactly. Like getting that structure right, again, on the front end just helps avoid confusion when it's time to account for this, and definitely when you're trying to disclose it to stakeholders and investors. All right, so let's pivot a bit here to the next. So once you've established that you're in a collaborative arrangement, so the guidance we just walked through there, I think the next question that we often kind of point people to think about is there a customer relationship that's also potentially embedded in the arrangement? And I think this is an important distinction because if there is, again, this is where ASC 606 comes into play. So even if the overall agreement is a collaboration, one party might still be acting as a customer for certain elements of the arrangement itself.
So let's say a biotech licenses early stage IP to a pharma company and also agrees to perform development services. If pharma pays upfront for the license and reimburses R&D expenses, we have to evaluate, is the pharma a customer?
Yeah, exactly. And if the license is a distinct good or service and the development work is provided in exchange for consideration, then yes, pharma is a customer for those units of account. So in that case, you'd obviously would apply ASC 606 to those specific components of the arrangement. And again, that's the guidance, you would use obviously a recognition, measurement, disclosure, no different than any other unit of account under 606.
But maybe let's say the clinical work is a shared effort. So the two companies are collaborating, jointly steering the research, making key decisions together, and splitting the cost. That part would likely stay outside of the scope of ASC 606 and be accounted for under ASC 808.
Yeah, right. Yeah, and I think that's, again, where there is the need to exercise professional judgment here, because determining which activities represent that customer-facing exchange and which are truly just collaborative. I think that's an important distinction where you do have to kind of look at the facts and circumstances. I think also one of the key principles in ASC 808 is that the evaluation is done, again, at that unit of account level. So just make sure you're looking at each distinct good or service in that arrangement, or, if you've got bundles of similar goods or services, and really trying to clarify, is there a specific customer for any of those?
And so just to clarify, if you have a bundled promise, like a license tied together with non-distinct R&D support, and part of that bundle isn't with a customer, then the entire thing falls out of ASC 606.
Yeah,
right?
That's right. Yeah. So ASC 808 tells us that if any portion of the bundled units of account isn't with a customer, then you can't apply ASC 606 to the entire unit. It all would stay under 808, and you can't really just kind of split that bundled arrangement.
So back to your earlier point, say one company is performing activities that are part of its ordinary operations, like a CRO conducting clinical trials. The counterparty may be a customer in that situation.
Yeah. So if one party's activities look a lot like what it normally does for its paying customers, and the other party is essentially funding or consuming those services, you may very well have a customer relationship in play. So again, in that case, the service provider is going to apply ASC 606 and the customer applies ASC 808 to account for its share of the arrangement.
So if there's one takeaway here, it's this: just because you're in a collaboration, it really does not mean ASC 606 is off the table. You got to zoom in on the details and be prepared to apply both standards, sometimes in parallel, depending on how the arrangement is structured. So let's pivot and really kind of go through an example. Maybe that might be helpful.
Okay.
We'll stick with the life sciences industry.
All right. Set the stage for us here.
So Company a biotech, enters into a collaboration with PharmaCo.
Okay.
Company A grants PharmaCo a license to commercialize its compound. PharmaCo pays $10 million upfront, agrees to fund 50% of the clinical trials, and promises additional milestone payments. So $5 million for IND approval, $15 million for phase 3 success, and then 10% royalties on net sales.
Okay. So let's break that down a bit more. So start with the license that you mentioned, right? So the license, if it's distinct in that arrangement, then the $10 million likely falls under ASC 606 in that example and would be recognized when control transfers, right? Assuming no future obligations or restrict kind of the use of that license, right?
Yep.
The milestone payments, I think you mentioned next, right? Those would be considered variable consideration in that arrangement. And with variable consideration, right, we do have a constraint within ASC 606, so that constraint would apply. The company must also assess the likelihood of achieving those milestones and recognize revenue only when it's probable, again, that significant reversal won't occur, like the constraint guidance you got to go through. And then kind of the last part you mentioned was there was a cost sharing arrangement included in there, right? So this component would likely be outside the scope of ASC 606, right? The parties are both in that portion of the arrangement. The parties are both investing and kind of sharing in the risk. So in that case, ASC 808 likely governs here. So reimbursements in that case could be treated as an R&D offset or as other income, depending on kind of the substance and probably some accounting policy elections that would be made.
And then what about the royalties?
Yeah, so royalties, those would likely fall under kind of the sales or usage-based royalty exception that sits in ASC 606. So revenue would be recognized kind of as sales occur and not before.
Okay.
So lots of components there, right, within that one example where you can see, I think to go back to our last section where you're, you basically can have several things that fall in different buckets. So 808 or 606.
Okay. So let's talk about parts of the collaboration arrangements that aren't within scope of ASC 606.
Okay.
At the beginning of the podcast, you mentioned, we all know 808 does not provide much accounting guidance. So what are we supposed to do here?
Yeah. So, and people probably don't like to hear this, but it does come up in GAAP from time to time, right? So this is where you've got the concept of like applying other US GAAP by analogy. So ASC 808 says that you should apply the appropriate guidance in those circumstances. And kind of weirdly enough, I think in many cases, like a lot of times when you think about what other areas of GAAP are the best kind of avenue to head down, like a lot of people still feel like ASC 606 is the best to apply, right? So obviously it's going to depend on facts and circumstances of those components, units of account that are in 808, but a lot of times when people look at other areas of GAAP, they still kind of analogize to 606. One thing to keep in mind, though, that if you do analogize there, whatever you're recognizing isn't technically going to be considered revenue, right? So, because it doesn't truly meet the definition of a revenue. So you can analogize to the recognition and presentation concepts, but I think you got to then still figure out like maybe how timing and even obviously classification and how you present that would look.
Yep. So let's say a company receives cost reimbursement for shared R&D. That reimbursement might not be revenue, but you could use 606 by analogy to determine whether to present it as gross versus net and then when to apply it.
Yeah, no, that's a great example, right? And so the analogy helps obviously with consistency and comparability, especially when there's performance-based reimbursement or a defined deliverable. But keep in mind, I think the SEC, and I know we'll talk a bit more about SEC, I think next, but they expect consistency in how you're applying this and obviously probably transparency there too, right? So if you apply 606 by analogy in one arrangement, if you enter into similar ones and, down the road or with other parties or whatever the case may be, you need to apply the same analogy to whichever guidance you're using. So just make sure you're being consistent.
And then you also have to obviously disclose the judgment that you are
yeah, exactly.
Using, right. So if
policies or whatever the case may be, if it's obviously significant and material to the organization, and for stakeholders and things like that, then definitely want to disclose that for sure and tell the story behind it.
All right. Speaking of disclosure, these types of arrangements can raise a lot of questions. And we've seen the SEC take a closer look at how companies are actually communicating their conclusions.
Sure. Yeah, that's right. I think in recent years, probably just given the rise in the number of these arrangements and becoming more relevant in obviously growing rapid industries like life sciences and SaaS and things like that. I think we've seen the SEC issue more comments kind of in this space, just asking certain companies that have these arrangements to provide greater transparency just to stakeholders, right? And I think oftentimes they're kind of honing in on a few things. So one thing is like whether or not any portion of the arrangement, like we've talked about, right, is in the scope of ASC 606. So just being clear on that so people understand that. Also understanding kind of the accounting rationale for classifying any income or reimbursements, like the example you just walked through. I think especially when companies are maybe labeling it as collaboration revenue and it's not truly kind of under ASC 606. So just kind of explaining that a bit more. And then just general presentation and consistency, right? Whether in the disclosures and kind of from reporting period to reporting period, and just kind of having a consistent way you're describing the information and presenting that information so people can understand it from period to period.
Yeah, and when the economic substance of a payment isn't clearly described, for example, like a milestone or a royalty that significantly impacts earnings, the SEC obviously is going to really want a lot of detail around that.
Yeah. And I think comment letters will often ask the registrants to explain how and when these payments are recognized, what guidance did you apply, how that conclusion maybe aligns with the nature of the underlying performance obligations, et cetera.
And it's important to highlight income statement classification as well here. So if a company presents milestone payments as other income in one arrangement, but maybe as revenue in another, SEC is going to start asking questions around why. They are going to set that expectations that they want a clear and supportable rationale for whatever it is you're doing.
Yeah. And then I think, you kind of get beyond the financial statements and even the disclosures within the financial statements. If you think about an SEC filing, I think you also need to make sure that your MD&A as well is providing context. And again, especially when you've got these arrangements and they're material or even non-recurring, right? Maybe it's a one-off type thing. Investors want to really understand what the underlying economics, timing, variability of those arrangements are. So making sure that you're also being transparent through the MD&A.
Yep. And like any other topic, right? Transparency is key. Whether the amounts fall under ASC 606 or accounted for by analogy, clear and consistent disclosure is going to help build trust both with investors and regulators.
Yep.
All right. So let's switch gears a little and talk about the contracting process, because the accounting and getting it right really starts before the deal is signed.
Oftentimes. Yeah. I mean, yes, I 100% agree. I would say oftentimes, like we've talked about, I think on past podcasts, that accounting is often like one of the left out of some of that. But, I think we always echo that accounting, finance, when, you're interacting with your operations, your legal team, whoever, right? Executive team, making sure that accountants are kind of part of the conversation early. And it's just a way to get ahead of some of the complexities that might exist, whether it's specific to this topic or other kind of topics when there's material agreements. Because, the way the deal might be structured or how things are potentially worded, that can impact the accounting, especially when there's kind of some gray areas and judgments that need to be made. So, I would say the things that are important to really understand from an accounting perspective and making sure there's clarity as those arrangements are being drafted up is like what's actually being licensed or shared, if anything, what milestones exist and kind of what triggers any of those milestones, whether development services are involved and are those optional, required, are they bundled with other things, kind of who owns whatever's being created here, goods or services, who kind of owns the output. Are there termination rights involved? What happens if the arrangement is terminated early? Just some of those items I think are important to just ask about and understand as you're developing the contracts.
And some of the trickiest clauses involve exclusivity, sub-licensing rights, and IP ownership. So these do impact control, which obviously in turn impacts revenue recognition.
Yeah, exactly right. And a license might seem distinct, but if the collaborator can't use it without future services, then again, you may not even have a separate performance obligation for that license. So just some nuance there, I think, that you need to kind of think through.
Yep. So just making sure, everyone's kind of in the same room, your accounting, your legal, and R&D, when you're putting pen to paper on these deals, just to make sure everyone fully understands like what the impact is going to be.
Yeah, because they're going to be asking later.
Yep.
All right, so let's walk through a more comprehensive example here. And I know we're kind of doing a biotech life sciences theme, so we'll stay there. So a walk through kind of a day in the life scenario of how a biotech might structure a collaboration agreement and how the accounting applies. Sound good?
Sure, let's do that. Okay. So let's say BioNext, a small biotech company, partners with PharmaMax.
Okay.
BioNext grants exclusive worldwide license for its compound, and PharmaMax pays $25 million upfront, $10 million for IND submission, $15 million for phase 2 completion, and 12% royalties on sales. And then also BioNext agrees to provide 2 years of development services and co-fund 30% of the clinical trials.
All right, so let's talk through kind of. It is, I know. I luckily I have it written in front of me so I can remember all these facts. All right, so step one here, right? I think is, and we talked about this at the onset. So just like illustrating that point. So is to identify what are all the different kind of performance obligations in this arrangement, right? So the license may be distinct, like the one you mentioned, if PharmaMax can use it without the development services. So if so, then the $25 million upfront is likely going to be revenue in that case. And then again, 606 would apply there for recognizing that when the control transfers. What about step two?
All right. So step two, you evaluate the milestones, which is the 10 million and the 15 million. We're going to say that those are variable consideration under the arrangement. So under 606, BioNext can only recognize revenue when it's probable that a significant reversal of those payments wouldn't occur.
Yeah, and that usually means waiting until those milestones are probably achieved, right? Yep. So unless you meet the criteria to recognize them earlier, which I would say is probably rare in a lot of development stage, early stage companies, just because of the level of uncertainty, it's probably not until it's actually happened.
So the development services might be a separate obligation recognized over time, say on a straight line or input basis.
Yeah. And then the co-funding you mentioned for the clinical trials, that's likely going to fall under ASC 808. Reimbursement, if there's reimbursements involved, like you mentioned, those, I think a lot of times we see those recorded as other income and presented that way. Or alternatively, we sometimes see it done as a reduction to any related R&D. So I think it depends kind of on the nature of that cost sharing. And again, probably just comes down to transparency about how you're treating those costs and presenting them.
Yep. And then finally, royalties. Those are scoped under the sales or usage-based royalty exception, meaning BioNext recognizes revenue as PharmaMax makes sales.
Yep. Cool. I think that covers all of it. For that example.
All right. Well, let's kind of talk about some common pitfalls and additional gray areas, as we've mentioned numerous times already. Obviously, these arrangements can be very complex. So what are some of maybe the most common pitfalls we see in practice?
Yeah, there's several. I think the first one is over generalizing, maybe, or oversimplifying the arrangement. So just saying the whole thing falls under 606 or the whole thing is not within the scope of 606. It's a true collaboration arrangement, and you're not really thinking through that true unit of account assessment that we talked about. I think another is, inconsistencies, especially with classification, right? So I think reporting similar items maybe as revenue in one arrangement, and then with another arrangement you've got stuff in other income, or it's on offset to an expense or something like that. So just not being consistent with how you're applying your kind of accounting policies in these circumstances when they're similar. I think ignoring reassessments. So, there might be a circumstance where you have a collaborator that becomes a customer later on, or maybe vice versa. So just understanding how that might impact the accounting again there. So whether that you fall in or out of 606 for certain units of account, if that relationship changes. And then I think, again, it's just probably about the transparency like we talked about, and then the presentation to investors and other stakeholders. So, right, just not being robust enough in your disclosures and really kind of explaining, especially where you've got milestone payments or royalty payments that might impact earnings, and just some of those other elements of the arrangement that need to be clear.
Yeah, and one of the biggest mistakes is misidentifying the unit of account. So you've got to separate the license from the services, from the cost sharing, and evaluate each piece under the right model.
Yeah. All right. So we talked pitfalls, but let's maybe illustrate some best practices here too, right? So just things companies, especially ones that are in early stages of structuring, or if you're kind of looking and exploring some collaboration arrangements, just some things to think through. So like kind of a roadmap, if you will, right? Yep. So I think like we talked about, right, engaging accounting early is probably paramount, right? So don't let your legal team or your business development team or whoever finalize the terms of the deal till accounting or finance has had a chance to at least understand and weigh in. I think breaking down the arrangement, again, like we've done in the examples that we walked through, I think, which were helpful. I think that's the exercise people need to walk through in their own arrangements. So what are the distinct elements that are in there? You got licenses, perhaps, services, milestones, are there royalties, are there funding arrangements? What's going on there? Really understand each of the kind of the distinct elements there. I think, again, customer relationships and really understanding who is potentially a customer and how that might vary from element to element or unit to unit of account. So who's paying for what, who controls what, understand that. Applying 606 by analogy consistently, if that's what you're going to have to do for those elements that are truly outside 606, but you want to analogize back to it. I think that's important, especially when you've got kind of R&D partnerships or kind of multi-year kind of cost sharing arrangements. And then, I think we say this a lot with a lot of judgment heavy areas of gap, or where you're having to kind of make decisions on things, is just documenting that, right? And really kind of doing that up front. Just understanding how you decided to treat certain elements, how you got to that conclusion. It's helpful for, again, if you enter into another one down the road, you know exactly how you handled this before, but also just from an audit perspective, like we always say, having robust documentation. And then again, just, enhanced disclosures and making sure the MD&A reconciles to kind of the disclosures and the story there.
And I'll also add maybe using a disclosure checklist or peer benchmarking to ensure you're covering key expectations from the SEC and audit reviewers.
Yep. Yeah. So, like I said, ASC 808 doesn't always give you every answer. It's very bare bones, I think, but in combination with ASC 606, you tend to have kind of a framework that you can navigate around. So again, I think it's just something people have to think through specific to their facts and circumstances, and just thoroughly document kind of how you made your decisions.
All right. Well, I think that brings us to the end of today's episode.
Okay.
In summary, collaboration arrangements really are powerful tools for growth and innovation, but they do require thoughtful, well-documented accounting.
Yeah. And so whether it's co-development in life sciences, infrastructure partnerships, we see that a lot in the energy space, platform sharing and tech, like we mentioned at the beginning. I think more of these arrangements are popping up everywhere. And so I think it's fair to say each one has its kind of unique accounting implications, and you really kind of have to think through them one by one.
Yep. And so if you're working through one of these complex arrangements or preparing for an audit, we hope today's conversation gives you at least a roadmap to follow. And obviously, if you need help navigating these issues, Embark can do that. We're always here to help support.
Yeah. And thanks again, right, for listening to Accounting Matters. And we always say, don't forget to subscribe and share. And we will see you on our next episode.